Good morning, ladies and gentlemen. Well, at the start of this video, let me admit that I'm completely and utterly puzzled. Puzzled because the markets just are giving so many contradictory signals that we, I'm just completely unsure about what is even happening, let alone what is going to happen. If you remember, I told you last week that the most important level to watch last week would be in TLT, the test of this trend line. And the trend line has been tested and the market held. In TLT, the market held, but in a variety of other fixed income instruments, it did not, which makes us very puzzled. Because either we break this trend line and break this moving average, which is somewhere around 125, and if we do that, we are almost certain to go and test the 200-day, which would be all the way down to 122.60. That would be an indicator of quite strong risk on. And as you know, our contention is that we are at a very big crossroad and we are going to get a major bout of risk off. Well, this is not the price action that we would expect from the test of a major trend line. We would have expected much more of a bounce, probably back up to here and closing the gap. It is possible that we haven't given it enough time, but on the other hand, this is not the kind of explosive action that should be taking place if we are indeed to have risk off on the books. This looks like very much like a correction to this move, and therefore looks more likely to break down than to continue higher. We are at very, very important levels. I mean, this is the Trump victory, and we have come back and we have filled that gap almost to the tick. So, what we do here is going to be extremely important because either we have a repeat of this and then risk on is very much on the books and we will probably make new lows. On the other hand, as I will show in a moment, the spreads are doing such weird things that we have to give it some time. When in doubt, I have always found that the best thing to do is to do nothing because we are at the cusp of a trend, of a very big trend. Either we buy volatility and stick with straddles and just wait for the price to develop, or do nothing, which I think in this case is probably the thing to do. And let me show you why. This is our old friend XLP XLY, and you can see what happened last week. A major move in the spread, but it came about by the move in XLP and no move in XLY. Bad earnings out of General Mills, and they completely thrashed the consumer staples sector, and this is the resulting move down every day last week and actually closing at new lows for the move. This should be a huge confirmation of risk on. On the other hand, if we have a look at what is happening in XLY over SPY, we will see that absolutely nothing really happened in XLY over SPY. So the consumer discretionary sector is still in the dumps. We are in fact just accelerating the turn in the moving averages, and it is more likely than not that XLY in a few days will continue to make new lows. Contradictory signals from XLP, XLY, and XLY, SPY. If we are going to have a bout of risk on, this should be now trading way up here, and it's not. So it's telling us to be very, very careful reading too much into this move in XLP, XLY. If we take that back, it is quite entirely possible that the market is actually moving with a lag, and next week we get a big move up in XLP, XLY as XLY catches up with what XLP has done last week. So very, very puzzling that we are having these moves which are cancelled between one week and the next. Is that indecision? Is that the bears fighting the bulls, and yet we don't have a victor? Yes, probably. But when that is happening, you probably want to get out of the way and keep your powder dry, and then jump on the trend once the victor is obvious. Also, very little progress in SPY over TLT. It is still in the same range as it has been for months now, a very tight range, and it has yet to decide whether it's going to break all the moving averages, which are now all in one point, and move down. Maybe I can enlarge this so you can see it better. You can see how the moving averages are all converging to a very narrow band, and we shall see what happens to this spread, because either it's going to start motoring higher, or if it breaks this trend line and the moving averages, it has nowhere to go but a long, long, long way down. And that is what's so puzzling. It is not making any move, which basically means no decision has been reached by the market. And no decision has been reached by the market because two of its largest sectors of the S&P 500, XLF and XLI, are so strong. XLF is just about to make new highs, even though the spreads of the future earnings of the banks are still in a very pronounced downtrend. As you know, it is our contention, and we will continue to believe, that this is utterly unsustainable. At some stage there will be mean reversion, and when that happens and XLF falls back down towards 21, 22, there'll be hell to pay in the indices. But for the time being, this is just defying gravity. XLF and XLI are the ones that are driving everything, while technology and the consumer sector and everything else is very much subdued. On the other hand, the big trades that we favor for the next few years keep on trucking. This is the old world index against the SPY. New high for the move. Let's have a look if we can enlarge this. I don't know why this machine is so slow today, but we are definitely still very much in the trend that says the world is a better buy than just the US. That's obvious even in Europe with dollar hedged, and it is still obvious in the old world, as is obvious in the emerging markets. basically this is saying that we are ready for either SPY to come down or for the rest of the world to accelerate much more than the US. So we shall see which is right. And here we have XLI over SPY. And you can see the huge move XLI has made in relation to SPY last week. It just burst higher. It is now at the best levels, really, that it has been since 2008. It is a very, very strong showing by XLI, which should be a risk on indicator. Is the American economy turning into an exporting economy? And that is why XLI is so strong. With the dollar so weak, they can afford to start exporting. Not convinced of that argument. So really quite puzzled by the big strength in XLI, but that is something that really has to be respected. It seems obvious that XLI together with XLK in the future will be sectors which will be very much strengthened by Trump's policies, and therefore it looks like it's unlikely that XLI is going to allow the S&P to come down all that much, because there will be continuing strength in shares like Boeing, which would just look very ready for breaks higher. So XLI is certainly moderating our bearishness, and if you have a look at the price action last week, XLI and XLF really held the market up. Without them, the market would be good 2 to 3% lower. So again, another mixed signal, but this one very much in the risk on camp. The one point of weakness last week was QQQ over SPY, which came down slightly. Yeah, as you can see from this chart, if you look at it, the trend is quite clear. The fact that it retraced this little bit last week is hardly momentous or very important. But it's just very odd that this market rotation keeps on happening, keeps on happening, keeps on happening, and you always find one sector or two or three which keep the market up while the others retrace a good 3 or 4%. It's just puzzling that it keeps on happening even at these valuations overall. So we wouldn't read too much negative into this. It it's just another factor that puzzles us rather than determines or confirms any of our views. This chart is SOX, which is the semiconductor index, against the yen. Still, as you can see, we've made new highs. There's absolutely no sign of risk off in this chart. The yen says that there is plenty of liquidity being provided to the market. The semiconductor index, which is one of the most aggressive risk on indices, still says higher. Absolutely no sign of a turn in this index whatsoever. It is very puzzling that some spreads are indicating so much danger ahead while others are so bullish. It is a puzzle which is incomplete. We are missing several pieces, and therefore probably the best thing to do is to admit to yourself that you don't know what's going on and that you are completely unsure at this stage, and wait for greater clarity. And here we have the S&P with the volatility ratio, and as you can see, we are now at the most overbought we have been for a very long time. This is one of the other side of the fence, which says you should be short here. Every time the index has been above 130, we have had a sizable correction of at least 50 points down in the S&Ps, which is only, what, 2 points, 2%. So completely puzzled. You cannot buy the market with this level of volatility spread ratio. It is just suicidal. So again, if you can't buy the market, but the spreads are not telling you to sell it because they're making new highs, I guess the best thing to do is do nothing until some trend emerges and you can jump onto it for a bit. The fundamentals say that we are hugely overbought at these levels. What is probably obvious is that liquidity is still ample and that people are buying any dip, however small, in the market because they need to invest more because they still have so much cash. That is probably the answer. We don't pretend that we know that. We are just getting that feeling by the way the market is trading. All dips very quickly are bought. There is almost zero downside, and yet the market is so rich, the market is so overvalued by any measure that you would have thought that at least the dips would be in the region of 2, 3, 4, 5%. Well, no, they're in the region of 0.1, 0.2. So it is very dangerous to buy, almost suicidal to buy at these levels, and the answer is maybe look to trade the individual stocks. I've mentioned individual stocks just to see how dangerous actually things are out there and how weird they are. This is a chart of Tesla, not because Tesla is an important company, it isn't. It is a very much a sentiment driven company. You would have thought that with the dollar staying weak, with XLI being so strong, Tesla would be a good candidate to go higher. Well, it did. It touched off a new high, set off stops, and then collapsed. Very much the same way as the market seems to be trading. It seems to be chewing people up and spitting them out. We all know that it is incredibly dangerous to buy, and yet people are forced into the trade and then they are spat out. This is not something that we want to happen to us. That's why we will keep the position size small. And this is, of course, not the only market that this has happened to. The other huge favorite is Apple. Exactly the same structure. Now this chart is beginning to look seriously bearish if it takes out these lows. The trend line in Apple is probably quite clear. This is the support. Well, this is 20% lower. I can't believe that a 20% move in Apple is not going to have a very detrimental effect to the indices. We are having such big moves in the individual stocks, which should be stable, and we are having the FANG stocks looking so sick that it is hard to imagine the market continuing to give us such contradictory signals. That is why I think it's best to admit that at least I don't know what's going on this week, and it's probably time to take it easy, wait out for the end of the quarter, and then reassess. There is no greater clarity in currencies. We are stuck between 118.50 and basically 120.50, 121. It is unlikely to break this range over the course of next week. Certainly, the fact that we have turned these moving averages and the market is so resilient at these levels tells us that we are more likely to make new highs than to consolidate below 116, let's say. There are probably so many buyers around the 115 to 116 area that the market is more likely to squeeze people and make them pay up ridiculous levels rather than filling them in at 116 and then taking off for 120, 121, 122. So still, I guess it is better to buy the dip until this trend line breaks. But even then, you're going to have very much a lot of support all the way down. So ideally, buying it around 116, but it doesn't look like that is going to happen. One of the very few charts which still gives us hope that we are right and we're approaching a major top in the equities is XIV, which we looked at last week. It is still not making a new high, and therefore it is encouraging our view that we are very, very close to a major top. But that is one of the very few indicators that are still in our camp. And even that one is hanging on by a fingernail. So early next week, we will probably sell some XIV, buy some VXX, or whichever way around we decide to do it, just because we feel that, most probably through options, just because we feel it's a very good risk reward trade to do it here. But we must admit, we are beginning to lose faith in our ability to predict this top around the 215, 245 level, simply because none of the indicators that we would rely on to confirm are doing anything like what we would expect of them at this stage of the cycle. Well, the biases are still very much unchanged. We think there's going to be a period of volatility in the fixed income markets. It is even more certain now because either we hold here or we go a long, long, long way in terms of yields. And if we hold here, we shall probably make new lows for the year in terms of yields. So volatility, probably the best way to play it, straddles. Bunds and Bobble, I haven't really shown you, but they're doing nothing. But they will make a move very soon. There is no inflation. Commodities are doing absolutely nothing. 215, 245, we still believe with all the reservations we've just shown you. We haven't seen a measurable increase in volatility, and that is the thing that worries us. We keep on saying there is no way the market is going to sell you cheap puts at the top, and we continue to believe that, although nothing is happening. That's probably because NQ hasn't started its last leg up towards 61.50, so probably indicates that we still have several weeks more churn at these levels before the markets make a decision. Haven't shown you the Russell because there's very little to see apart from the fact it's made all-time highs, but a break back would be significant. But again, we are not waiting for anything spectacular next week. We still favor the super cycle, which is world equities, i.e. European and emerging markets, over US. We think that is a position that's going to make money for in the very long term. DX, we'll see, again, it's completely dead. 9507 is going to be an extremely good sell. We have our orders in there. We are very doubtful it's going to get there, but if it does, we are very, very interested in selling dollars at that level. Thank you very much indeed for listening, and speak to you all on Monday.